Welcome everyone to Life Stage Brokerage webinar. Our special guest today is National Gold Consultants. We have worked with National Gold Consultants for some time now, offering services, products through National Gold Consultants. And today we have Nathan Akers. Nathan's been a longtime friend to Life Stage Brokerage. The company, National Gold Consultants, has been around for a number of years. Nathan, I'm going to go ahead and turn it over to you. I want you to just kind of share with the audience your background and why you're here today.
Yeah. Thank you for that warm welcome, Chris. So my name is Nathan Akers, and a little bit about National Gold Consultants and myself. We're both located here in the good northern state of Minnesota. So I apologize for the Minnesotan accent if that comes through. A little bit about myself. I've been in the financial service industry for 20 plus years at this point. I've got my MBA in finance. I've got a BS in business and economics. And really, I transitioned to the gold and the silver side of the business after the 2008 recession and market crash that we had, because I sat across the table from hundreds of clients that, really just were underprepared and they hadn't utilized physical gold and silver. And I realized that this was really a misunderstood and often underutilized asset class. So I wanted to help people better understand that and do it with honesty and integrity. And that's what we aim to do here at National Gold Consultants.
Thank you for sharing, Nathan. And so, hey, just for the audience to know, so as Nathan goes through his presentation, you might have some questions. You've been muted on entry, so you are not able to state anything by voice, but we do have chat features on the enabled. So if you want to send a question through chat, or you can text me at 515-210-5771 if you have a question for Nathan. So those are just a couple quick announcements. So Nathan, tell me, why is gold and silver? Why does that make sense?
Yeah, it's a great question. Why gold and silver makes sense? Well, first, I think right now we've got to look at, just the environment that we're in. Because that really comes into play for why gold and silver makes sense. We're at this unprecedented time in history where we've had an incredible amount of monetary stimulus created by the Federal Reserve over the last 18, 24 months at this point, roughly $15 trillion. And the reason why gold and silver makes sense in a portfolio is because when you expand the monetary supply like that, you're going to get inflation. Eventually, to combat inflation, the Fed's going to raise interest rates, which is going to cool the stock market. And what we've seen throughout history is really that gold and silver has this inverse relationship to inflation vis-a-vis the dollar, and then also to the stock market. That what happens is when the market goes down, historically, we've seen physical gold and silver go up pretty substantially. Very good.
So I know you have a prepared presentation for the people on the call today. So let's just, before you get into the presentation, I know you're going to address some of this, but one question that popped up from the last workshop, and it's always been it's kind of an interesting question, and I'd like that you address that question before it pops up on this one, is what do you believe that the motto, don't fight the Fed, do you believe that motto applies today?
Yeah, I think it does. And so when we think of the motto, don't fight the Fed, basically the kind of the underlying belief underneath it is, the Fed is going to do everything that it can to stimulate the economy there, and to stimulate the stock market. We're going to have quantitative easing. There's going to be the printing of money. They're going to do what they can to have money pouring into the stock market and to make the economy look good. So don't fight the Fed. Go along with that. That's the sentiment behind don't fight the Fed. And that's very true from a bullish standpoint, but the reverse is also true from a bearish standpoint. Don't fight the Fed. And what's happened is the Fed has been backed into a corner right now. You've got, the CPI at roughly 7%. You've got the highest levels of inflation you've seen for almost 40 years. And really the only tool that the Fed has to combat that is to raise interest rates, which they've said they're going to do at least 3 times this year. The Fed doesn't want to, but the Fed has to blow up the stock market, essentially. They're going to cause a market crash, and they're going to have cash come out of the market. So when we say don't fight the Fed when times are good, the same needs to be said when times are bad. Don't fight the Fed. The Fed's telling us, we need to see market flow or money flow out of the stock market, and we're going to see that happen. So don't fight the Fed.
Very good. Well, thank you for sharing that. That's excellent. So, let's get into the crux of why the people are here today to listen to, why gold and silver makes sense, but it's a special kind of gold and silver, right?
Yeah.
Nathan? Okay.
Correct.
So let's talk about that.
Okay. Yeah. Let's get into kind of the nuts and the bolts of it. So really quickly, I'll talk about what's different about National Gold Consultants. The first thing is when you hear gold and silver advertised, on the TV or online or, the radio, any place that you see like that, they're all retail outlets. They're not licensed fiduciaries, meaning they can really do whatever they want to benefit themselves, which unfortunately they do. And so you've got to be very careful of some of the pitfalls inside of the gold and silver industry, and our firm at National Gold Consultants, working with our advisors like, Life Stage Brokerage, and having the accountability of all these rules and regulations and guidelines, even if the I word of integrity wasn't there, which it most definitely is, we still have to act as licensed fiduciaries, meaning doing what's in your best interest. So we'll cover, kind of the main reasons, Chris, of, why gold and silver, why now, how much do I need, the best ways to own gold and silver, and we'll get into the nuts and bolts on that, and then the popular questions that get asked a lot, and then we'll open it up to Q&A at the end. So
and we might get questions throughout the presentation. So if I do, I might interrupt you. So
absolutely.
Thank you.
Yeah, go for it. So let's dive into why gold and silver. Well, very simply, it acts as wealth insurance. This is, and I mentioned this earlier, but this is a currency and recession hedge for inside of your portfolio. And this isn't a piece of paper of gold and silver. And I'll explain the difference between paper and physical a little bit later on, Chris. This is actual physical metal that's going to be delivered to you in your possession. And the 3 main things that I'm going to cover is the inverse relationship that precious metals has to our dollar. We talked about this briefly earlier, to real estate. And I like the real estate example because it helps tell us when's a good time to buy precious metals and when it's a good time to look at exiting precious metals. And then lastly, we'll cover the inverse relationship that it has to our equity markets. So moving forward into our dollar, I love this chart because it shows us in a very graphical way how our purchasing power is stolen through inflation. If you look at that left side of the chart, that's 1913, and that's the year that the Federal Reserve was created. And, it's significant for a number of reasons. One, because, of that don't fight the Fed that we were talking about earlier. And the other reason why I think it's significant is that, contrary to what many people think, the Federal Reserve is not a government entity. It's a private entity. It's a separate entity with no accountability for the money that it prints. And they've got their own vested interest. So we've got to be very careful looking at the Fed. And the whole history of how the Federal Reserve came into existence is actually pretty fascinating if you dig into it. So going back to 1913, the Fed created the first dollar, with air quotes. And in 1913, a dollar would give you $1 worth of purchasing power. And you can see on the bottom of the chart just exactly how much a dollar would buy you at any given point in time, whether it's 1913, 1929, 1933, et cetera, and then how much that would cost you today. So fast forward to where we are in 2022, right now, with the devaluing of our dollar. And the way it's devalued is just, printing money, and then your dollar continues to buy less and less over time. So when, for example, when gas prices were $5, $6, $7 a gallon during the last recession and crisis, it didn't mean that was better gas that you could put in your car. It's just that your dollar buys less and less over time. And you can see it today in our grocery prices, our healthcare costs, our energy costs, et cetera. I could make an incredibly long list for you. But anyways, fast forward to today, and we've lost 97% of the dollar's purchasing power since the creation of the Federal Reserve in 1913. And that doesn't mean that your checking and savings account went from $1 to 3 cents. It just means that your purchasing power continues to buy less and less over time. And in the last 60 years, or the last 6 years, I should say, we've actually seen our purchasing power lose 60% just in the last 6 years. And that's this whole concept of exponential function that we'll talk about a little bit later. And it's only going to get worse.
So just for the crew, just for the group, exponential function is printing money.
Yeah, exponential function is, well, if you look at the graph, so you can see over on the left-hand side how it, it starts, very high up, and then it, just craters to the floor. That's basically exponential function in reverse. Exponential function is, like you've got 1 of something, then 2, then 4, then 8, then 16, then 32, and it's growing exponentially. And we're doing that same thing with our monetary supply right now. And, I mentioned earlier that, the $15 trillion that the Fed has printed in the last year, and we've heard that word, or last 2 years, I should say, and we've heard that word trillion so much that it's kind of lost its meaning today. So I like to use a second to put it into perspective. 1 million seconds is 11.5 days. 1 billion seconds is 31 years and 8 months. And 1 trillion seconds is 31,688 years. And we've added $15 trillion to the economy in the last 2 years. And this is the real reason why you're seeing the inflation numbers you do in the news, and why it's not going away anytime soon. Now, the last piece about our dollar and the inverse relationship gold and silver has to it is our real inflation numbers. So you'll hear on the news about how, the CPI is at 7%. And this chart looks at what real inflation is for us, and I'll explain what's significant about it. So the blue line is, in my opinion, what real inflation truly is today. And the red line right now is the current government calculated consumer price index, or what, they refer to as the real inflation number. It's, it's the number that you hear shared on the news all the time. And why it's interesting to me is that over the last 40 years, they've actually changed how they calculated inflation 4 times. And, making it appear less than it really is. And why would our government do that? I mean, why would they do that to us?
Could it
And
be
there's,
reelection? Could it be political?
yeah,
Maybe reelected?
it could be. Who would have, there's three main reasons. So first, our social security increases are tied directly to the CPI. You keep the CPI low and the government doesn't have to spend as much on social security. Essentially, they temporarily solved the social security problem by just tweaking a math formula. Second, tax brackets are adjusted annually for inflation based upon the CPI. Keep the CPI artificially low and push people into higher tax brackets and generate more tax revenue without actually raising taxes. And then third, by keeping the inflation numbers artificially low, our real GDP numbers are artificially boosted, making our economy appear stronger than it is. So that's why they've changed the formula 4 times over the last 40 years. What they used to calculate back in 1980 to calculate inflation, that's what that blue line is. And it was sufficient enough then. Because what they've done by changing the formula those 4 times is they've removed a few minor things that we use, like groceries, gas, healthcare costs, energy costs, all things that you and I use as consumers, the things that make up the bulk of our expenses.
So to get somewhere, so they basically eliminated where we go to eat food. If the cost to travel to get to the food,
right,
the gas that goes into the car, all those don't count as far as inflation.
If you don't look at those things, then inflation is still bad right now, even according to the government. That's when it's not great. So, again, if you include those things, right now we're at double-digit inflation, and it doesn't mean that you're losing, 10 or 12% out of your checking account every year. What it does is that your buying power loses 10 to 12% every single year. And that's a very significant event. So if I were in your shoes right now, I would be thinking, well, how does gold and silver actually help protect me against inflation? And to highlight how gold and silver protects against inflation and protects your purchasing power, I like to use the example of the Ford Mustang because I am a red-blooded American male. So back in 1964, when the Ford Motor Company released the iconic Mustang, the base model sold for a little under $2,400. I mean, just let that sink in. You could buy a brand new Ford Mustang for a little under $2,400. Fast forward to here we are almost 60 years later, and the same amount of silver that was worth $2,400 back in 1964 is worth a little over $94,000 today. That's enough to buy 3 base model Mustangs today, or, I think much more importantly, for almost $95,000, I could go down to a dealership and buy a top of the line 2021 Mustang Shelby GT 500 for a little over, 75,000 and still have 20 grand left over for all the tires I'm going to shred and the gas I'm going to guzzle in that thing. So that's what I mean by physical gold and silver, helping to maintain your purchasing power over time. So let's move into the real estate illustration cycle. And, this is really when I calculate, or how I calculate, when it's a good time to buy gold and silver and when it's a good time to sell some of my gold and silver. So if the slide will advance, there we go. All right. So gold and silver has this inverse relationship with real estate. Typically, when real estate is high, gold and silver is low, and then they'll flip-flop and you'll see real estate fall and gold and silver rise. So what we're going to do is we're going to take a look back at the last 50 years at what could have happened if you'd perfectly timed the peaks of the real estate market and the peaks of the gold and silver market. And we're humans. I mean, we can look back in hindsight and say, that was really easy. That was simple. And in reality, we can come close, but, perfectly timing something isn't going to happen. So this is just an illustration looking back in hindsight in reverse of perfectly timing something. So we're going to call that guy in the middle with the briefcase, John. And John, back in 1970, he had a home a little bit before that, and the housing market hit its peak in 1970. So what did he do? Well, with that inverse relationship that if the housing market is high, gold and silver is low, he sold his house for $25,000 and he bought gold with it. Then with that inverse relationship, John waited for gold and silver to flip-flop with real estate. And it happened. 10 years later, in 1980, he sold his gold for almost $750,000, and he bought real estate with the proceeds, bought 12 homes. Waited another 20 years, and real estate was at a peak in 2000. So John sold his 12 houses for, a little over $2 million and bought gold again. Waited another 11 years, and he sold his gold at the peak and once again bought real estate when it was low. Bought 83 houses this time for $18 million. Then 9 years passed, and John decided to sell his real estate again in 2020 since real estate was at a high, and he bought gold. He sold the 83 homes for $30 million, bought a little over 21,000 ounces of gold that today is worth $40 million. So he went from owning one house worth $25,000 to owning over $40 million in gold just by perfectly timing things. And I showed you all of this because the question that I get asked all the time is, when do I know to buy or sell? I'm not in the trenches like you are, Nathan. And my answer is just follow the real estate market. It's very easy. So how can we apply this information to today? Well, I think that we can all see that real estate's at a peak right now. We've got these real estate values that are exceptionally high. You've got interest rates that are historically low. And I think that we can all figure out, hey, when the Fed starts raising interest rates and we start seeing mortgage interest rates rise, we're going to see that housing market cool.
So Nathan, I want to interrupt you just for a second. I just got a comment from a text, and it stated, are taxes included on this scenario that you're I don't think it's including taxes.
No, it's not. Okay. Yeah, it's not including taxes.
It's just basic math to illustrate.
Yeah, just basic math to illustrate the point. Exactly.
I hope that answered your question, Craig. Thank you.
Yeah. So I'm going to move forward into the last inverse relationship, and then we'll get into the nuts and the bolts of physical tangible metals. So we're going to compare the 2008 recession versus physical gold and silver. And we'll use the cliche example of Mr. Smith, who's got $1 million portfolio. And that's everything that everybody at Life Stage Brokerage is already doing for you. You've got your well-protected money, well-protected and safe money, some that's a little bit more at risk. So we tend to talk about physical gold and silver acting as wealth insurance inside the nest egg of your portfolio. And the absolute bare minimum that I would recommend is a 10 to 20% allocation to physical gold and silver. And, and on $1 million portfolio, that's $100,000 at the low end. And why is that insurance? Well, that 10% is going to protect the other 90%. The other 90 are all dollar-based assets. They're all tied to the dollar. So if the dollar does poorly, it's going to negatively affect, equities, real estate, et cetera. And what we found over the years, the decades, really even history, is that a 10 to 20% allocation tends to protect the other 80 to 90%, that's in the market or that's tied to the dollar. So I'll give you an example on the screen of what happens if a market pullback occurs. So we can see back in that 2008 crash with a 10% allocation to physical gold and silver, the other 90% of your portfolio declined roughly 40%. And that's a very conservative estimate because the S&P 500 actually declined 56.8% during the 2008 recession. So we can see the 900,000 that he had in the market declined down to 540,000. But with the inverse hedge, his physical gold and silver increased from 100,000 to 445,000. So Mr. Smith had a net loss of roughly $15,000. And you can see that in this example, a 20% allocation allows you to not just ride out a major recession, but actually profit from it. We can see that Mr. Smith grew his nest egg to 1.39 million because of the inverse hedge of gold and silver. I mean, either way allows you to avoid burying your head in the sand and hiding your statements during a market pullback. Now, am I Chicken Little saying, the sky is falling, the sky is falling? No, but we are in uncharted waters right now. And history tells us that now is a good time to be in physical gold and silver. Let's just say there isn't any more market correction, which I would argue is going to occur, for one thing, because of we can see what happened in the market in January. And as the old saying goes, as in January, the rest of the year, it's basically an indication of what's going to come. So let's just say there isn't any more market correction. Well, then you've still got the inflation protection of your physical gold and silver. And I'll show you a chart in a couple of slides called the US debt clock that really shows what gold and silver should be valued at based upon all the money that's being printed currently. So here we go.
And I just got a comment from Dave, and he said, looks, it's more of a comment, not a question, but he said, interesting, the gold and silver then can buy back into the market at the bottom and give you some benefit. So
yep,
dollar cost averaging, for the people that don't know what dollar cost averaging is, it's a great comment. We're not going to get into what dollar cost averaging is today, but it is a excellent point. So appreciate that. Thank you for the comment.
Absolutely. And this chart just shows very simply how during the last 50 years, during all of the largest declines of the S&P 500, physical gold and silver have had double, if not triple digit returns when the S&P has been down double digits. So it just highlights that inverse relationship. And like Dave said, when your physical gold and silver are up, take some of those gains off and plow them into the other asset classes when they're down. It's a great way to increase your overall wealth. And basically this chart looks at, physical gold and silver as wealth insurance. It's on one side of the seesaw. So I like to make the very audacious claim that, I hope you buy physical gold and silver and then it just craters in value, because that means that everything else you've got is doing phenomenally. Conversely, when everything else is falling is when physical gold and silver is rising. So it's all about maintaining your overall wealth level, not necessarily increasing your wealth level. So why now? Why does it make sense to add gold and silver to your holdings now? And I'll start by talking about exponential function. A gentleman by the name of Dr. Albert Bartlett created this theory years ago of what exponential function is. If you remember that first dollar chart, we talked about it there. You had the start of 1913 up in the left-hand corner, and then you saw the value just decline in the shape of a negative bell curve. That's exponential function in reverse. This chart here is what exponential function looks like. And this is a chart of the M1 money supply in the US. So it's updated with all of the money that's essentially in circulation. And you can see over on the far right how it just goes up in, the shape of it basically just skyrockets. That's what adding $15 trillion in 2 years will do. So to illustrate how exponential function works, I like to give an example based upon being a baseball fan here in Minnesota, which is a lousy place to be a baseball fan. But let's just say I'm at Target Field, home of the Minnesota Twins, and I'm in section 330, row 30, just the complete upper deck, and I'm handcuffed to my seat for an hour. And there's a gentleman on the pitcher's mound with an eyedropper of water. And every second he's going to drop a drop of water. and it's going to double every time. So first one drop, then two, then four, then six, then eight. And I'm not worried about this at all up in my nosebleed seat. At a minute 45, the infield is barely saturated. 8 seconds later, 8 seconds later, by a minute 53, the entire stadium is engulfed in water and I'm drowning in my seat. That's the power of exponential function. And that's exactly what we're seeing right now with all this money printing, essentially. I mean, just imagine what 6 or 9 or even $12 trillion would have done back in the 80s, the 90s, even the dot-com crash. It's just this unheard of amount of money, but we have to do it now. Yeah.
Yes. So for the new for the new people, the new clients or the new potential clients on the call today, they may not know the term quantitative easing, but essentially quantitative easing is what you're talking about.
Right.
The money printing that they've been doing because they were worried about the COVID crisis. They were worried about the 2007, 2008 housing crisis. So since 2009, they've essentially just thrown trillions of dollars at this through money printing, correct?
Right. Correct. Yeah. So that's what they've done. And, this idea of printing money out of thin air, it's not a new idea. It's not a new thing. During the Roman Empire, they couldn't print money out of thin air because they actually used physical gold coins. So what they did instead was it was free to enter the Colosseum, but what you had to do was hand one of your coins over to a centurion that had a special little tool that would clip just a little bit off the edge of your coin. Unfortunately, I don't have any of those coins with me because they're in museums now, but you can Google them and find the images. And for the time being, your coins still spent the same. But what happened was the Roman Empire was smart. They collected those clippings, they sent them off, melted them down, refined them, and made new coins. So essentially, over time, the value of your coins got diluted and bought less and less. But unlike the Roman Empire, we're not hemmed in by a finite supply of gold or gold coins. We can just write a check out of thin air that devalues our purchasing power, or the Fed can, and we have absolutely nothing we can do about it.
So I received a chat from Peter, and I don't want to interrupt your flow, but he is wondering if the slide deck would be available on this particular presentation. Would that be available to him okay. Just wanted to ask. I've never had anybody ask me for this actual slide deck, but okay.
Yeah,
great.
We can do that. Absolutely.
Hope that answers your question, Peter. Thank you.
Yep. So I'm going to move forward because I mentioned the US debt clock earlier. So I want to show this to you. So this is a screenshot from usdebtclock.org. This is as of the very end of last year. And if you go to it live, you'll see the numbers just constantly adjusting. They're always going up. They're not going down. If you look at that purple circle over on the left-hand corner, so the U.S. national debt is $28.5 trillion. If you go to it live today, it's over 30 trillion right now. It's just this staggering debt that we're incurring as a nation. But what's even more fascinating is if you look at that box that's or that circled box in the center of your screen, that's the debt to GDP ratio. And right now it's at 128%. And why it's interesting is that because we know from history that a debt to GDP ratio of above 90% tends to lead to hyperinflation eventually. I don't know that we're there. I don't know that we'll get to hyperinflation anytime soon, but we do know from history that is what seems to happen. So if you fast forward, which you can do in the upper right-hand corner, and take a look at, what our debt as a nation is supposed to be 4 years into the future, the U.S. national debt is projected to be close to $50 trillion. That's, spending on the same rate that we are right now, with a debt to GDP ratio of 186%. So we can see it's not a pretty picture. We can tell that there are storm clouds on the horizon. what's really interesting is in the bottom right-hand corner on the site, you'll find the dollar to gold ratio and the dollar to silver ratio. You can see the blue arrows here that I highlighted. And why it's important is because these numbers represent what gold and silver should be valued at based upon all of the currency that's in existence right now. And why it's interesting is because right now, they've got silver at, they're saying it should be a little over $3,000 an ounce. The paper spot price is in the mid 20s. Gold, they're saying it should be $21,000 an ounce. Right now, it's $1,900 for the paper spot price. So I'm not calling for gold and silver to hit these numbers. I don't think it's completely far-fetched in the future, in the environment that we're in. But I'm also not hoping for gold and silver to hit these numbers, because we talk about only a 10 to 20% allocation to physical gold and silver, acting as wealth insurance. And just like health insurance, life insurance, auto insurance, you really hope that you never have to use it. But just like any sort of peril event, it's there if you need it. And the same principle really needs to be applied to your wealth. And I tell everybody that's looking at this from an insurance side of things, not an investment side of things, that you really need to be careful what you wish for. Because if gold and silver continue to rise up in value like they're doing right now, it just means that you're losing money out of your other buckets, really, whether you realize it or not. So let's move forward to the next thing. How much do I need? And which is a common question that comes up. And the short answer is really, you need enough to make a difference. You need enough that it's going to act as wealth insurance for you and make a difference when you really need to offset the other losses in your portfolio, either due to inflation or a market correction. So I'll ask a rhetorical question. If your home was worth $500,000, would you insure it for only a quarter of what it would cost to replace it? No. Yeah, it's silly, if not downright foolish. I mean, sure, you could say you had homeowners insurance, but if your house was wiped out, it wouldn't really do you that much good. It'd be incredibly hard to rebuild. And, just like in homeowners insurance, you don't want to buy too little. You also don't want to buy too much, but I see people do this all the time with gold and silver. They'll have $500,000 in investable assets and they'll put $20,000 into gold and silver. And they're like, yes, I've got 20,000 in gold and silver. I have so much protection. But when you do the math, that's a 4% allocation. So let's look at what a 4% allocation, how that would have protected you during that 2008 crash that we experienced. So with a 4% crash, with a 4% allocation, as I mentioned earlier, the S&P declined 56.8% during the 2008 market correction. So you had 480,000 in the market that fell to $207,000. But don't worry, you've got $20,000 in gold and silver, right? Yeah, you do. And it did increase to almost $120,000. However, your total portfolio still ended up down $175,000. So you just saw your net worth cut by 35%. However, let's take a look at a 20% allocation, which means you put $100,000 into gold and silver. You see what a difference that makes? Your total portfolio grew to $761,000. Then you can take some of the gains from your gold and silver off the table, rebalance your portfolio, and buy everything else when it's low. Now, that 20% number isn't just pulled out of thin air. A recent study by a company called the CPM Group, they're a commodities research firm, shows that a 20% allocation to gold and silver is really the long-term sweet spot, where you're going to minimize the risk in a portfolio and you're going to maximize the return. And essentially what they did was they back tested portfolios from 1968 until 2020. And, they charted them on this nice little chart here. And what you can see is that adding anywhere from 0 to 20% decreases the risk of the portfolio while increasing the return. If you get above that 20% allocation, sure, your average return still increases, but your risk also increases as well. What's interesting is they did the same study back in 2016, and at the time they found that an 18% allocation to gold was that optimal sweet spot. So we can see over time that 18 to 20% allocation really has held true to be the best long-term allocation to physical gold and silver. So why is it important to have enough, gold and silver in your portfolio? Well, like the investment guru Peter Lynch says, you can lose money very fast in 2 months, but you very rarely make money very fast in the stock market. Gold and silver isn't about making money. It's about protecting what you have so your overall wealth level doesn't suffer. So now that you know why to own gold and silver, and how much you should have, let's talk about the best way to own it. So paper versus physical. Paper, what I mean by that is that's what you can have in an investment account. Think of like a stock or an ETF. And to highlight the example between paper and physical, I like to use the example of toilet paper. Back at the beginning of all this, pandemic craziness, March 2020, when you couldn't find toilet paper anywhere, would you rather have had a certificate good for a big 72 mega pack of Charmin toilet paper, or actually had the multi-pack at your home? Which one would you take? I know which one I'd prefer. I mean, we can look back at history. We can know what exponential function is. We can have all these facts and figures. But we do know that we're on this sinking ship right now with all these fiat currencies, meaning currencies backed by absolutely nothing. So by buying paper, gold, and silver, you're not really into it. You're essentially into another thing backed by absolutely nothing. The most common symbol for paper gold on the stock exchange is an ETF, an electronically traded fund, with the ticker symbol of GLD. It's very cleverly named. And what's interesting about GLD is when you dig into it, it's actually leveraged out 200 to 1. Meaning investors think they're buying, physical gold, but really they're buying a piece of paper of gold that they happen to be owning with 200 other people with you. So the reality right now is you really need physical possession. You need to know that you actually have it. The other reason why we're not big fans of paper is if you look at, just the silver and gold, paper, silver and gold, for every ounce of physical silver in existence, there are 300 ounces of paper silver that are traded on the exchange. For every ounce of physical gold that's in existence, there are 110 ounces of paper gold that are traded. So you need the actual physical, asset class at this point.
Nathan, I just got a text from Carolyn, and she asked the question: when I'm looking at gold and silver, I see spot price.
Yeah.
Can you explain what spot price is to the?
I absolutely can. So basically, spot price is the value of metal that's in the ground. So when you go online and you Google, what's an ounce of silver today or an ounce of gold, what they're going to show you is they're going to show you spot price, which is, derived from the futures price of gold and silver. Now, any physical coin that you buy, any physical metal, is always going to cost more than spot price. Spot price is literally just for paper. It's what paper shares trade off of. And it makes sense that the physical costs more when we stop and we think about it. The example that I give is, let's say that I wanted to buy my wife a dozen roses. So I could, go to a florist and it cost me, $40 for a dozen roses. or I could go down the street to a nursery and buy a packet of seeds for just a few dollars. And it's not that I got ripped off on that difference between the couple of bucks and the $40. It's that somebody's taken the time to plant those seeds, water them, tend them, spray them for aphids or, whatever, mold or whatnot, and then harvest the roses. So whether I'm buying roses today, 5 years from now, or 10 years from now, I'm going to pay more for fresh cut roses than I am for seeds. And it's the exact same thing with metals. Somebody's taken the time to actually mine that metal, refine it, mint the coins, store those coins, ship them, etc. So the physical is always going to cost more than spot price. But spot price can give you kind of an indication of what's going on with the market. So I'll move on to the best ways to own gold and silver. I think the first thing most people think of with gold and silver is bars. Like, I am going to buy some gold bars or some silver bars. It's going to be like Fort Knox at my place. And the reality is we're not big fans of bars for a couple of reasons. First and foremost, if you need a little bit of liquidity, you need to raise a few hundred, a few $1,000s. You can't easily just shave off a bit of a bar, to get that liquidity. The other reason why I'm not a big fan of bars is that the vast majority of people have not spent thousands of dollars on the equipment to test the metal that the bar actually says it is on the outside is the same metal all the way through. And because these are big ticket items, there is counterfeiting that happens. I know it's kind of surprising, but yeah. So we're not big fans of bars for those reasons. I think the next way that people think of with gold and silver is I'm going to buy collectibles. I'll buy these slabbed collectible coins. This is, I'm going to get this, inverted edge letters from a 1907 coin, or, a rare Great British penny, etc. I like to refer to them as like the Mickey Mantle, the baseball cards of the gold and silver world. They can be really interesting and they are a fun hobby, but just like in the 90s, how you wouldn't have wanted to, put your wealth insurance in Beanie Babies. It's the same thing with collectibles. The vast majority of their value is driven by collector sentiment, which isn't what you want. So the final way, to look at gold and silver is coins, literal gold and silver coins. And which we are big fans of. And when you look at gold and silver coins, there's, you'll see that they kind of are broken down into two main categories. The first is going to be pre-1933 coins, and the bottom is going to be post-1933 coins. And by the year 1933, I mean the actual year 1933, the year that the coin was minted. And that's what I mean by pre and post 33. So, from an educational point of view, if you already own physical gold and silver and you own it in the post 33 version, I'd suggest getting together with your advisor and just talking with them about it, because there are a lot of pitfalls to that. If you're looking to purchase wealth insurance with your non-qualified assets, which is what I recommend 99% of the time, you're going to want to use pre-1933 coins for a number of reasons. First and foremost, it's a private asset class. And what I mean by that is it's completely private. There's no reporting of it anywhere. When you buy it, you'll see it's a one-page order form. It's got your name, your address, and then the breakdown between gold and silver. We don't need your social security number. We don't need your blood type, your mother's maiden name, security questions, your beneficiaries, any of that. It's a private asset class. Nobody knows that you've got it. And essentially what that means is when you're buying a private asset class, it's as simple as writing a check out to NGC. with nothing in the memo line. There's nothing that indicates you're buying gold and silver. Because in all reality, when it's private, that means it's private now and it's private in the future. All you're doing is you're converting your dollars into real currency. And when you want to convert that real currency back into, the fiat dollars, it's as simple as just, giving us a phone call, letting us know, and then we'll walk you through that and cut you a check as soon as we receive the metals back.
Nathan, Jim asked, what makes it private? Why is it private? How is it? What determines that it's private?
So the reason it's private, it's actually fascinating if you look into the history of these, Chris. So, prior to 1933, the US government in our coins, we minted physical gold coins. We were on the gold standard then, and we had gold fixed at $20 an ounce for an ounce of gold. So, a quarter ounce gold coin had a face value of $5. When you look at the history, we entered the Great Recession, or not the Great Recession, we entered the Great Depression. And in order to pull us out of the Great Depression, FDR in 1933 confiscated private ownership of gold coins. He ordered Americans to turn their gold coins in, and then in turn they would get, cash for them. Now those coins and he did the same thing with silver starting in 1934. It was late 1934. We talk about pre-1933 because it's easier to have one date that you go by. But what happened is those coins that survived confiscation through subsequent legislation from Congress, they were deemed a private asset class. Essentially, they were deemed as, hey, we don't need any reporting on them. They've already gone through confiscation once. We don't need to know where they are, when they're sold. We don't need 1099s issued. It's really one of the last private asset classes that's still truly private and out there right now. Now, because there is no reporting required on them, if you're looking at putting gold and silver into, your IRA, your 401k, anything like that, you can't use pre-1933 coins, because any retirement account like that you've got, the IRS wants to know what you've got so they can tax it, track it, and know where things are at for reporting requirements. And clearly, a non-reportable private asset class doesn't really play well with that. So we're required by law to use the newer post-1933 coins. The other reason why I'm a big fan of the pre-1933 coins for non-qualified assets is because, and if you've thought about this at all, you'll probably have noticed this already. They're not making any more of them. The amount that are out there is fixed and actually getting smaller over time as coins get, destroyed or, defaced, things like that. So, the value of these coins, being a private asset class, being a physical coin that actually exists, over time, we're seeing the value of these rise. Whereas with the post 1933 coins, they can always just mint more.
So Nathan, there was a follow-up, real quick follow-up text. It just says, do not need to claim tax, ?
It's an honor system, Chris.
Okay.
There's no 1099 that's issued. And there's no reporting that goes along with that. It truly is an honor system. So
very good.
Now, the question that comes up often is, gold or silver, what's better? And I would say there's no wrong answer. This is one of those times that both serve as wealth insurance. As is human nature, I try to get the best bang for my buck. And you'll see in the center of the screen, it's got the gold to silver ratio of 80-1. And how we calculate that is we take the price of an ounce of gold and we divide it by the price of an ounce of silver. Which means that it takes 80 ounces of silver to equal the value of 1 ounce of gold, which is much, much higher than the historical average going back over 350 years of a 30-1 ratio. So what it means in layman's terms is that right now, for silver to get back to historical normalcy, it would need to increase 126% from where it stands today. There's no wrong answer between the two, between gold and silver. They're both going to serve as wealth insurance. Personally, I'm a little more biased towards silver right now because silver's got so much more potential without gold moving a dollar. In the interest of time, we'll cover the popular questions. So the first popular question that I hear asked a lot is, now that I've got it, where do I put it? You ship this to me, Nathan, and just to answer that question, the way that works, everything that we send out gets shipped out in tubes. The tubes are double boxed. Each box is wrapped in strapping tape, which is like packing tape on steroids. The boxes are completely confidential. There's nothing on the outside to indicate that it's gold or silver on the inside. Everything gets sent via FedEx Express, and the return address label actually will say custom granite tile. It's all insured from the moment it leaves us until the client signs for it. Before we ship, we actually call the day before to verify that you'll be around when it's going to be delivered. And when we ship out, we send you the tracking information. And of course, we track everything all the way through. So now that you've got it, where do you put it? And the first thing I like to say is, there are many different creative ways that you can use, whether it's, putting it in a safe, hiding it, a safety deposit box, any of those things. Nobody knows that you have this. So, just don't go sharing that information with a lot of people. And I think the second thing to be mentioned in there is, I think most people, let's say you're putting 100,000 into gold and silver and you're doing a 50-50 split. You're thinking, man, they're going to have to back the Brinks truck up to my house and they're going to be delivering for hours. And the reality is $50,000 in gold can fit in the palm of my hands. 50,000 in silver can fit into a medium shoebox. So coins don't take up very much room. And we can always find some way to make storage work for you, even if that's storing it in an offsite location. And whenever you do need to liquidate, which is the next part of the question, how do I get out? How do I liquidate? Because it's important to look at exit strategies. When you need to liquidate, you let Life Stage Brokerage know, you let us know here. Essentially, you can send those coins into us. And as soon as we receive them, we'll cut a check and get it out to you within, it's a 24-hour turnaround time from the time that we receive those metals. Because they're not making these anymore, we always want to get them back. If for whatever reason, and we don't take any haircuts or charge any fees or anything like that on the back end. And if for some reason, in the very unlikely event that we were no longer around or you didn't want to sell to us for some reason, there's a very ready market of dealers, of coin exchanges, of jewelers, of just a network of places that you can liquidate these, because these coins are always in demand. They're always wanted because they are unique, they are private, and they are physical gold and silver. So it's that simple. And with that, I'll turn it back over to you, Chris.
Excellent. And I want to be respectful of everyone's time today, since we said it would be an hour. So just in some closing thoughts, closing questions. If you have questions, feel free to give me a call at 515-210-5771. Nathan is available for, on some cases, for some consultation if you are wanting to consider this as part of your portfolio. If you already have an existing advisor, a financial planner, again, some financial planners are not aware of pre-1933 coins. They might be looking at the returns based on spot price or other avenues to kind of determine whether they should be recommending gold and silver. These coins are a special value, especially the pre-33 coins on the gold and silver side. So you want to make sure that when you're talking with your advisor, if you're not already working with a life stage advisor, to help them understand the difference. Now, that being said, I am a certified financial planner with over 25 years of experience. And until I met NGC, I was one of those advisors. So I understand the power. I've seen it work for clients, especially over the last couple of years. At the end of the day, please make sure you reach out to me if you'd like to be in contact with someone with the Life Stage Brokerage Network. If you are outside of the Midwest, I do have connections throughout the United States that can help you. Remember this, don't do it in a vacuum. Make sure it's part of a full financial plan. Take some time, don't make a rash decision, but look at your overall portfolio. If you're interested, I do a thing called asset mapping, which will help you make a decision on what would be the right allocation for you. So again, feel free to reach out to me at 515-210-5771 or email me at cweston@lifestagebrokerage.com. The replay will be available if you'd like to see it again. Feel free to email me and I'll be happy to get that out with some white papers and a follow-up video to you. With that, I'm going to conclude this call. Nathan, as always, you do a great job. Appreciate your time today, sir.
No problem. Thanks.
Thank you.
You're welcome.
Bye-bye.